we wanted to discuss today responsible management and how has the COVID crisis, in fact, affected us in trying to think about sustainability as an investment. And it certainly has become a buzzword amongst the elite in the investment industry and the elite in corporate industry in America, particularly, but also in Northern Europe, to suddenly talk about sustainability as a newfound thing in the light of COVID, because they realize that sustainability means that you have the business going on for longer. And before we do so, I just wanted to talk about kind of assumptions that we seem to have as investment community and assumptions that we seem to have as a society. And somehow as a society, we have this very odd notion that the world is divided into separate parts. There is clearly a part that we call our citizenship sphere, which is we're citizens in a country, and I'm talking about developed countries. We vote governments in, we pay taxation, and we have a say, albeit over time, in what kind of country we want to live in and what we want to spend our tax dollars or tax pounds on. And then there's another sphere we live in where we are normal citizens who live in a community, and that is the companies we work for, the companies we buy from, the companies that our businesses supply to, and so on. And that we call the business world. And then bizarrely enough, we think there's a third world called the investment world. And that's a place which is inhabited by the markets, by companies that are quoted on the stock exchange or private equity companies. And we again think that that's a separate sphere. And in reality, they're one and the same, or at least there's a Venn diagram that overlaps the same, because we as investors, collectively through, in America, our 401ks, through our pension schemes, whether defined benefit or defined contribution, here in mainland Europe, all of us happen to be investors through our pension schemes and our savings. So we own the companies, we are shareholders. We happen to be stakeholders because we, the same group again, are the people who buy from these companies, and we're the people who work for these companies, we're the people who supply these companies, and so on. And finally, we are also, at the same time, the people who are affected by the actions of these companies because we live in the communities. And while we think that we can control our destiny in terms of how our tax dollars are spent, somehow we're not thinking enough about how we can control our destiny in terms of how the corporate world shapes the world that we live in. There's a further thought that we all seem to have, which is erroneous, and that is that somehow trying to benefit our savings is a matter of trading for financial return. That's all it is. It's a kind of a trade. And there's nothing wrong with that as a concept. I'll come back. There is actually mathematically something wrong with it, but we sort of isolate what we do in trying to own the companies that we invest in from, in fact, what the companies do to us as employees and to us as citizens in the communities that we live in. And I think the COVID crisis has brought all of that up to the brink, in a sense, in that we have had to rethink very hard about what sustainability means. And I think it's right and proper that we think very hard about what our reaction ourselves as owners of companies through our savings, as stakeholders in the companies through our employments, same thing, as citizens in the companies through our regulators, what it is that we want sustainability to mean in a post-COVID world. Now, let me start at the beginning and talk about this idea of how to approach markets. And for us at Hermes, in the beginning, this is going back at the inception of Hermes in 1983, it seemed to us that there's a matter of time. In other words, you can try to make money over the long term and you can try to make money over the short term. And we came to the conclusion that trying to make money over the long term is much easier than trying to make money over the short term. And if you do that, it actually cascades a whole bunch of activities and actions that eventually result in what today we'd call sustainability. So at Federated Hermes, we take the view that it is perfectly all right if what you want to do is approach the market and investments in companies in the market simply as a trader. It's legitimate, you're short term. But our argument is that in fact it's very hard. And if you do see the charts that somebody will manage to send to you, you'll find that 36% of managers in the market beat the benchmark. So if you look at the market out there and you think about alpha and you think 36% of the managers beat the market. Aha, you say, well, that is an argument to go into beta index. Well, it isn't really, because beta only works directionality. So if the market is going down as a whole, you're going to lose. And that is not, therefore, a sustainable way to create wealth without even going into the long-term sustainable ability of making money. It is simply an inefficient way of making money. If 36% of fund managers actually manage to beat the benchmarks, and the benchmarks themselves are simply directional, and you're betting whether the dollar goes up or down, whether the S&P goes up or down, it's a losing battle. So if you really believe in trading, then what you really should do is go to Las Vegas and hire a very good poker player and get them to, in fact, invest your money. Because 55% of poker players, in fact, have a positive hit ratio. In other words, they're better at it than people who try to trade markets. Now, of course, when we invest our money in the market, we're not just trying to make money, even though that's the shorthand for it. Because what we're trying to do is create a sustainable economic infrastructure that we can live in as we go forward. And we at Federated Hermes have always believed that the idea that there is, again, this tension or this contradiction between sustainable long-term wealth creation and between making money is a false narrative. I started by saying to you it's about the long-term versus the short-term, and that in the beginning of Hermes in 83, there was the realization that it's easier to make money over the long term. And from that, in fact, cascades a whole series of decisions and actions that, in fact, turns an investor into a responsible owner of the capital or a steward of the capital. And intrinsically, if you think about it, it is common sense. Meaning, if one had a private company, if one's entire investment universe was simply a single private company, and that is how you make your livelihood and that is how you want to retire, then the person who owns that company would think that the most important thing at all is to ensure that the company survives, that it has sustainability at its core. And in trying to ensure that it has sustainability at its core, that person would look at several facets. They'd look at a sustainable business plan, for example. Well, what does a sustainable business plan mean? It means that they are producing something in a reasonable way, that they have supply lines that benefit them and the people they're getting the supplies from, that they have social license in the community they live in to actually sell the product that they want to sell or provide the service they want to provide, that in fact the customer is benefiting from what they're doing, that they guard themselves against unintended or unforeseen hits, whether it's environmental or whether, like now COVID, they have a sustainable balance sheet, and that in fact they control it well, and that's governance. So we've just articulated the E, the S, and the G in ESG almost without thinking about it. When we expand this to think about a portfolio, we at Federated Hermes International never understood why you want to differentiate, provided you're a long-term investor, between the way you would run your own business if it were a singular business, and between how you'd run all your businesses that you own. And so acting on behalf of our clients as their fiduciaries, and in trying to protect their long-term sustainable wealth creation, we came to this idea that in fact you have to inject stewardship at the heart of what we do. And you have to inject high active share. Now, high active share is very broadly being very different from the benchmark. Because I said to you at the beginning, the problem with the benchmark per se is that then all that you're buying is a market directionality which you have no control over and which is haphazard. And if the benchmark were to go down, then you go down. If the benchmark goes up, you go up. And then you're hoping that over time it goes up more than down. But actually, that's a false hope. On the other hand, if you have high active share, what you're doing is you're specifically controlling what you want to invest in. You're choosing investments. You're no longer betting. You're not betting whether the market goes up or down. You're not betting whether a certain sector is going up or down. You're not even betting if a certain factor is going up or down. What you're doing is choosing businesses that you want to invest in for the long term, as if you owned a single business. And if you apply the same stewardship concept of responsible ownership of the product, what you end up doing, in fact, is creating a much more resilient business that's much more likely to withstand exogenous shocks as we've seen with COVID, much more likely to survive over the long term. And if you treat every single investment that you invest in as if you're a responsible owner, what you do is you manage to create a better outcome for the portfolio, for the clients that we represent. But in reality, what you do is you end up creating a better outcome for the wider community. And let's think about this for a minute. A sustainable business that operates with a sustainable business plan, just to look at the pure business aspect of it, that looks after its workforce, we know leads to a higher efficiency quotient. In other words, businesses that are that have a good relationship with the workforce actually have higher efficiency quotients. They are more efficient, they are more productive. There are many experiences of that. We know that if you have a strong relationship with your supply base and you treat them with dignity and with respect and with fairness, rather than trying to perhaps use your power as a main buyer against them, that you ensure their sustainability. And there are many examples of this across markets. And therefore, together, you're more likely to withstand and be more resilient when you have things like the COVID crisis or other exogenous shocks hitting you. When you have a product that you are selling to your client base or a service that you're providing to your client base at a fair price, and it is what the client base actually needs, not just now, but over the long term, you have a sustainable and repeatable business. And finally, when you wrap this up within the concept of social license, doing it in a way that is acceptable, in fact, to society as a whole, and you manage to get your private license to operate, you ensure that you're resilient against the possibility of interference by the regulators. Now, each one of these is in fact a pure economic factor if you think about them. And I'd like to just discuss some examples of them all. When we talk about the efficiency of the workforce, there is a very famous company in China that if you own a phone, makes the chips that go in the chips that go within the phones. And they used to have a problem with their workforce whereby they so treated on mainland China their female workforce badly, or treated them so badly that they had a high incidence of suicide. We engaged with that company over a long period and convinced them to change their ways. But the argument with them was that, in fact, if you change your words, it's not just a better outcome for the ladies concerned, but in fact, it's a better outcome for the business concerned. Because it is inefficient. It sounds harsh, but if we'd gone and said to them, this is against human rights, they wouldn't have listened to us. What we said to them was, look, this is not an efficient way to do business. You have a problem with your productivity. And once they treated their workforce better, they themselves noticed that their productivity went up and the efficiency of the factories went up. And over time, they came back to us and said, you're right, in fact. That is the efficiency of treating your workforce better. So we can then take that and give an example of a construction company in the UK which so treated suppliers badly that when it was hit with an economic crisis, a developer in the UK, in fact, it failed because its supply chain was not able to support it at the time when the company needed it. So this company was doing really well as a very large construction company. It hit some bumps in terms of finances. It needed to rely to some degree on its supply chains, and its supply chains buckled. And that's an example of inefficiency. Governance is another example. The Volkswagen example is a very good one. It's if you think about what happened within Volkswagen and the whole scandal about the emissions, that was this governance scandal. Nobody in Volkswagen was evil. What happened was that there wasn't the structure around a very powerful CEO that allowed the message to come up to him from the engineering staff that what you're demanding of us is simply unachievable. That in reality, we cannot produce the test that you want with the reduction that you want at the price that you want. And so people tried to bend into the will that they saw, and the unintended consequence, which I'm sure the CEO never wanted, was the whole cheating scandal that destroyed the share price. The idea that ESG has a financial value has now begun to have traction across the marketplace. 5 years ago, when we discussed this, we were seen as eccentrics. Nowadays, we're seen as actually saying that which is normal. And we can certainly prove that governance is one way in which you can add value very demonstrably. People talk about the environment as well, and to me, the environment is a very clear case of we can show you how value already is discounting various environmental issues, and we're not talking about the environment simply as global warming, although that's one of it. It doesn't matter what you believe in. It doesn't matter if you believe there is global warming, whether it's man-made or not. The fact is, if you have a business, the business has either factories or has communication lines that are next to water, you are being charged a higher price by the insurance companies to reinsure them. If you're unaware of that and you're not adapting to that, you have a problem. If you produce a product that in fact uses pollutants, this will come back in the sense of higher regulation, and that will come and hurt you. These are all financial factors. So even the E is becoming much more accepted in the mainstream, even if you don't accept the idea of global warming. And there are some in parts of the world who do not accept it. But understanding it and understanding how it plays within your investment allows you to, in fact, end up with a much more long-term outlook and a much better long-term investment horizon. The sustainability argument is the S is social impact sometimes, and to me that's simply social license, and that comes in two ways. There's a very good example in the UK, for example, where there's a multi-chain coffee shop from the United States, which was in the newspapers a few years back, with a story that they were not paying the tax they should pay into the United Kingdom and directing it through Ireland, which is actually, by the way, perfectly legal. And in fact, the population was so incensed that they went on a buying strike. And within a week, said company paid something to the tax person to the United Kingdom. Social license is important. Again, it doesn't matter what you believe, whether you believe that electric cars are actually in the round more carbon neutral or not, because the carbon that goes into manufacturing them, the whole issue of how you get rid of the batteries and so on, it doesn't matter. The truth is that there is a social trend, the S if you like, which says that people in cities in Europe are choosing to go to electric or hybrid cars. And we certainly know that that is then cascading into regulation, and that by 2030, which is not a long, 35, sorry, in London you will not be able to buy a new car which is not electric or fully hybrid, and the same in many European cities. So it becomes a social trend that translates into money. Now, the key here is the argument I've made so far has been entirely based on the argument that, in fact, if the objective of the free market system is simply to generate financial returns, then we have demonstrated through the 30-year history of Federated Hermes International, formerly Hermes, that integrating stewardship and responsibility is a better way forward. In fact, we can so demonstrate this that we can show that when we engage with companies, and by that we mean we have a stewardship service which was started in 85 in its inception and became formalized 15 years ago, called EOS, where we represent often clients who have index funds and go and talk to companies over a 10-year horizon, discussing their strategy, their resilience, their practices, their values, their purpose. And our argument to these companies is that we come here not as activists in the sense that we want to buy and sell you because we represent people in index funds. We come as stewards, as co-owners, as partners, helping you achieve the best possible outcome that you can. And we can demonstrate that where we have engaged with companies on specific topics on behalf of our clients, and we represent about $1 trillion of assets in active stewardship, there is a very clear outperformance versus other companies in that same sector. Surprisingly, where we've engaged and the companies haven't listened to us, there is still some outperformance because the market perceives some movement in these companies. So right across the gamut, responsible investment, stewardship, has been shown to lead to better financial results. And that has been our argument, that there is no conflict between doing good and good investment. They're one and the same thing. And the conflict only happens, to go back to the beginning of my talk, when you start thinking about short-termism versus long-termism. It's only if you're a short-term investor that you really want to trade the market, and only 35% of the short-term investors manage to beat the market. And so if you're really going to trade and be short-term, why not go to Las Vegas? But if you're going to be a long-term investor, then being a steward of capital, thinking about sustainable wealth creation, looking at proper governance structures, engaging in long, active stewardship with the companies that you own, being very differentiated from the benchmark, thinking about social license, thinking about the whole community and stakeholders is simply a way of enhancing financial returns.